Hi there traders, and welcome to Trade the Structure. So we're going to go over the major markets at the moment. I'm seeing that the US potentially could bounce. You can see it on the screen right there. We've got this S&P 500. Now in Australia, which is where I'm based, is they just raised rates. So we were expecting a 0.25 basis point rise, or a 0.25%. Instead they raised it by 0.5%. So it's basically the RBA going from a stance of we're not going to raise rates until 2023 or 2024. To actually raising it by 0.5% and admitting they probably got the inflation or the strength of inflation quite wrong. So I think it's time to go and have a look at the markets. Our market actually sold off after the news because it caught a lot of traders off guard. And you can see that just flushed straight down, but then the US has actually rallied last night and it brought the futures market straight back up again. So it's going to be a choppy market. I think there's two arguments, obviously. You've got economics, so you've got economic numbers are strong. If they're raising rates, it's because it's a stronger economy and you've got a cool with regards to inflation. Now, we've got a housing market problem in here. It's a massive bubble at the moment, I believe anyway, and I don't see any problem with raising rates. It needs to be cooled, but a lot of people suggest the opposite. Looking at that, if you go across to the US, now they're weighing up the economic data that's coming through with regards to high inflation as well. So if the RBA is anything to go by, I think the Federal Reserve is going to be quite aggressive as well with raising rates. So the market is really trying to decide, are they going to be aggressive or are they not? Is the economic data still coming out really strong, meaning inflation is going to stay high, even go higher? Rate rise is going to be more aggressive. Or some of the data recently has been, on the low side of estimates anyway, and it's been down from previous marks. So that is kind of what the way up is. If it's starting to cool, which means inflation has probably started as peaking or maybe starting to come off, the Fed won't need to be that aggressive. But it's a balancing act at the moment, and you can see that by the choppiness of the market. The market has sold off. This is the S&P. You can see it has been sold off quite aggressively, and then we've found a little base here. Now we've been speaking about this for quite a while. You've got you can see that's your initial move down, your secondary move down. We found the base. That was where we projected it would go to potentially, and now we're starting to bounce. That's all it is. We've just broken through the anchor at 40.80, and we're consolidating sideways as momentum's coming off. To me, is a good sign for bulls. I would expect that's probably going to drive higher. You probably go to test 4,300, maybe above, but I think that leg down is going to correct a bit more than just this little pop up. Okay, we'll have to wait and see. We got US CPI numbers, which are inflationary numbers, out on Friday, and we'll see a bit more how stubborn this inflation is, and potentially is the consumer weathering the storm. Now, Target come out last night, and they said they've got a lot of inventory out, which means that consumers, i.e. buyers, are not soaking it up like they expected with this higher inflation and things, which means they could be tightening their belt. I mean, they've got to pay other things that are a bit more important than things from Target. Your petrol, your mortgages, your food, all those sorts of things, your bills. They're a lot more important than going to Target and shopping. But it could show that potentially the consumer over there is tightening their belt a bit, even though they're still spending. The debt levels are still pretty good. They're potentially redirecting money to certain places, which are because of higher inflation, okay, and they're probably going to be a bit tighter. They're not spending willy-nilly. So that's, it's a massive balancing act in there. Let's look at the Dow now. Oh, that's in the US, not in there. But you've got, same sort of thing. We've broken up to the upside. We're bouncing at the moment. We're consolidating sideways. Momentum's coming off. It's starting to, potentially, if it starts to pick up again, we're going to rally. We're going to rally into that 34,150, even potentially higher at the 35,340. Okay, and Nasdaq, you're looking at that. It's probably lagging, not really lagging, but it's got the same sort of price action. Now you can see that was clearly getting soaked up. Every time it sort of popped down, they'd ramp it up. It popped down through the new low. You can see just in here, took out this low, rammed it straight back up. Held it here, ramped up, flushed through the lows here, straight back up. So every time it's getting flushed into new lows, someone there, the algos or whatever it is, wanting to drive it back up again. Okay, so to me, longer term, that's looking like consolidate sideways as momentum starts to come off. Sooner or later, momentum start to pick up again, and it's probably going to rally. Okay, if we don't fall over from here, obviously. But to me, that's what technically that's what we're looking for after we come off this nice little base here. So that's essentially a high low off a double bottom or an RTF. All right, so that's in the US indices looking like there's for a bigger bounce back up again. In the DAX has been quite strong. We popped up into this level here. It was at 14,570. Looked like it wants to go. I mean, it's still holding higher lows all the way up. I would expect that if the US is going to bounce harder, we're going to drive it back up into this 14,888 level. Now, ECB is coming out, I think it's tomorrow night in Europe, and they're going to talk up rates. They're going to say what their basis is, what they're talking about inflation. So that we may see that the market's going to be a bit capped especially in the European markets, maybe a bit capped, but maybe they're going to just drive it higher and higher and higher, okay? Because, again, it's the same sort of scenario as the US. The economy's doing better. Obviously, they've been funded, with QE and things, but inflation's high, the economy's growing, the numbers are coming out pretty good, apart from, forget about the debt levels. That doesn't seem to be a problem for anyone, but, as long as the economic numbers are getting better, they're talking up inflation, they can keep inflation at under control a bit, then the market could keep grinding higher. But it's when inflation is out of control and they can't do much about it, they've got to start raising rates a bit more aggressively, and that could really throw a bone to the stock market. Because remember, when we're talking about yield, if you've got shares that are on highs, which they are, we're not talking just over the last 30-minute charts, which I'm looking at. We're talking weekly, monthly. They're on highs. The US is just coming off all-time highs. We're not far from all-time highs, considering the bigger picture. So when you're talking at shares and yield, how much more yield can you get when there's an interest rate rising cycle? Okay, rising interest rates are better for bonds, so they're not jumping into bonds considerably just yet because they're expecting higher yields. Now they will start as bonds keep coming down and the yields get bigger. So yields are going up when bonds are going down. As the yields get bigger, there's going to be flow of money, major flow. We're not talking mums and dads. We're talking funds. We're talking instos. They're going to be flowing money potentially into bonds because they know that they can get that guaranteed yield at a certain level and keep adding to that bond portfolio as yields keep going up in the interest rate rising cycle, which is it's just starting. Okay, and that means there's less money to go around into share prices to keep pushing it higher. So if you're buying up at these levels, you can be, but you got to be specific with your time frame and know exactly what your time frame is. You're not just jumping in here expecting, if it comes down a bit, I'll hold. Okay, if there's going to be a big, if there's going to be a turnaround to the downside, we don't know how big it's going to be. I am thinking that look, there's going to be a bit of a hit sooner or later, but how big, what it's going to be, we don't know. But you don't want to be holding long stocks from these sort of levels. I'll be more inclined to just sort of hold off for a bit, average into some that look good and have been beaten down a bit, and know exactly where your risk is. That's pretty much the key. If you don't know where your risk is, you're guessing. Okay, so that's the way I'm planning of attack for me anyway. Over to the UK, rather than rambling on, we've got this level here that's held 75.40, flushed in there, bounced straight back. But we've still got this big level here at 76.83, which has been holding for quite a time. Look at your daily charts. This is only a 30-minute chart. It's retested off that level quite a few times, fell away. We're up there now, so of course it's going to find a bit of selling pressure. Potentially anyone in here, anyone that's been buying it up here, maybe taking some risk off the table because we're going into that interest rate rising cycle, which is really traditionally not good for share prices. Over to the XJO. You can see the market was heading south up until RBA. So RBA was somewhere around this zone in here. We're on a 30-minute chart. You can drill it down, see that they got caught off guard, another 0.25% straight back down again. But since then, because of the US, we've actually rallied on the open today. We held up. So it's not uncommon in the overnight session when you got the futures market was very thin and illiquid. If they want it higher, I'm not saying, not conspiracy, but they can ramp it up there. Okay, so they get a better open on the XJO or the ASX to potentially take some more risk off the table. If it keeps going up, so be it. They don't really mind. The higher, the better when you're talking about your shares if you're trying to get out. Now, what they don't want is the market to get smashed. Okay, so it can actually get held up. The market, you can see, if the US gets hit pretty hard, we can actually grind down, and you can see that. So when the market opens, they're not getting a really bad price on their share if they need to get out of it. And that's all potentially, if I'm right, and they are unwinding some shares into the local market. But for me, you can see, we've got longer term, we've got massive overhead resistance up here. Failed quite a few times, 76.15. Okay, we're on a 30-minute chart. If you scrunch it right up, there's trend up, failed. Okay, failed here, ramped up, double top, failed. Okay, we've got another ramp up and we failed again. So really for me, this is looking more like a shoulder and another leg down than anything else. Okay, there's no reason why you can't grind back up. But to me, that's not the kind of environment. It's not what I want to see if I want to add risk to the market. You don't buy the dips. To me, that's just a crazy mentality. Okay, you want to buy on the rise. You want to buy when we got this retest fail here and you've got this nice little zone, if you can draw that up. This nice little zone in here, which to me is a shoulder to the upside. That's where you want to sort of be buying with the anticipation that you're going to trade into these highs, so you've got momentum on your side. Down here when the market's coming down, momentum's not on your side, it's against you. So, to say you want to buy some shares in here, could go down here, could go down here, could get absolutely poleaxed, you don't know. But as long as it's going down, I'm not keen on adding any shares to a portfolio or looking to jump in, just trying to pick the bottom. because for me, trading's about understanding the fact that you don't know which way it's going. Okay, you can have a bias, but you've got to have a bias with risk control. Okay, you don't just have a random bias thinking if it goes down, I buy more, I buy more, I buy more, because there's going to be that one time, and then it takes one time where you get absolutely cleaned up, you lose everything. Okay, so it's really just a matter of, if you're going to buy, where's your risk? If I'm going to buy here, I have to know that my risk is potentially below here, right below that 69, 65. If I'm buying a basket of shares, for instance, if it's on the rise here, it's a lot easier. It breaks to the upside. My risk is that the ASX reverts down. I might want to start taking some risk off the table. But if when it's on the way up, my MAs are up. That's what I'm looking for. Okay, because momentum is on my side at the moment. We're below the EMAs, so the EMAs, exponential moving averages, and it's not looking so crash hot at the moment, especially when we're going to that interest rate rising cycle. Okay, we'll not worry too much about Asia. Let's take a look quickly at the US dollar, and then I want to get over to gold, oil, the things that are probably people are trading with regards to inflation. And then we'll just look at the cryptos. I think that's very important at the moment. So we're looking at the US dollar. US dollar's backed off this level at 102.77. That's why I got a bit of love back into and into share market. And you've got a bit of a sell-off here. Whether we're going to hold a lower high in here, we're going to start to roll over. The market has gone below the EMAs and then straight back up above them again. I mean, it could have the fact that we're going to get above it, maybe go sideways and extend back up again. This looks like a prime area for a higher low. You've got a rough, probably maybe look, it could go a bit lower, but you've got a nice little zone where it could easily be bouncing off this level here at 102.20 and then heading higher. It's just all about where traders are positioning for inflation, and it's a really, like I said before, it's a balancing act between inflation. Controlling inflation is going to get further out of hand. It is quite high at the moment. It's very high at the moment. It's going to get further out of hand. Are the Fed going to stand around and pick their noses, for lack of a better word, or are they actually going to do something? And they're only going to do something if the economy continues to show that strength. So US dollar is really, like I said, balancing act at the moment. I feel that it could probably press back up into these highs. If it starts to fail again, we're going to get a lower high, and we might start attacking down to this 101.68. If not, we're going to keep grinding higher. Okay, over to gold. You can see that's not acting too nice, and it's starting to head south. So that's because of the strength in the US dollar. So that's purely at the moment. It's not an inflation hedge. It's not a safe haven at the moment. It's just a US dollar trade. Okay, US dollar's up, gold's down, and vice versa. We've spoken about this many times before. So don't get caught up in the thing that gold's lower. It's going to be bought up because inflation's high. No, it's not. That it should be. We should be trading $2,000 an ounce if that's the case, but it's not. We're holding this off this level at 1856. Market's heading south. Are we going to sort of have a bit of a pop-up, or are we going to just continue down to this 1830 level? We'll have to wait and see, and it's going to be dependent on that US dollar. Now, oil's the one that you want to be watching for inflation. The higher this goes, the more inflationary pressures there are, and the more lingering inflationary pressures there are. And at the moment, you can see it's very, very choppy. They don't want it to go down. The fundamentals reasons why it's not going down is because of what's happening between Europe and Russia. Everyone's sort of turning their back on Russia and the oil supply there. So there's a sort of limited oil supply, and OPEC didn't raise it enough to what people thought. They should have raised it a lot more to cool these prices. They didn't. They don't, let's be honest. If the higher the price for them, if you're selling something, the higher price, the better. So why would they raise it too much? They don't mind the market hanging around this 120 level. It's better for them. If they raise it too much, you might find that all these longs unwind and the market comes crashing down because they've raised it too much. To do the right thing. The right thing is all personal, I guess. The right thing by them is not the right thing by a consumer. Okay, and it's the same with any business. So for me, this level's holding at 117.60. We're trading around that 120. Any sort of push up here and retest and hold, we're going to go to higher levels. And if you scrunch that right up, higher levels could be right back to these levels up here, which is around 130. So there's no reason why it can't press up into these highs. Okay, so at the moment, that longer term trend's up. That's your move up, your secondary move up. We've hit that secondary level at 120. People are fading that level, selling into that level, potentially ready to get squeezed out, because at the moment, that trend is still up. This leg's up, had a bit of a breather. The new leg's still holding, okay, as long as that 117.60 holds. So we'll see how that goes. Just a quick look at bonds. Bond yields are going up, which means bond prices are going down. So when yields are going down, bond prices are going up. So at the moment, yields are going up. So they're factoring in higher yields, higher interest rates, and at the moment, they're still heading south. So that's the 2-year. The 10-year is much the same. Yields have been coming down for quite a while. Yields have been going up for quite a while. Bonds have been going down. All right, so we'll keep an eye on that one too. Bitcoin. So over to cryptos, we've got a couple of minutes left. I just want to cover off on these. Now, crypto, that you can see that that's 30,000 mark. It's been very choppy, had a bit of a ramp up, flush straight back down. It consolidated sideways, ramp up, flush straight back down again. So buyers at the moment can't get a foothold into the market. And I suggested if the indices in the US start pressuring higher and we do break out to the top side, it is still, remember, it's still a bounce in equity markets. It's not a trend higher. It's just a bounce of the trend down. So that's probably what the Bitcoin that is looking for. Now, if it does start to break down, we get onto the daily charts here. This is a level it's trying to hold at the moment, and that we've got a flush. At the moment, it's a flush, and we are holding it. But if it does start to break down here, the longer it consolidates, and buyers are trying to ramp it higher, and they keep failing, then that's going to go lower. And if it starts to go lower, there could be a massive unwind of margin positions, and that's probably the key thing. If there's a big unwind in margin across the board, that could trigger other markets, because generally, your bigger funds, they're in Bitcoin, they're in this, they're in that, okay, and they're using margin. Now, if you have to unwind in one area, it can flow over to other areas as well. So that's the bigger concern here. I think if it does start to unwind here, and you get margin positions getting hit, and people have to unwind, then it could flow over, and it could flow over to margin positions in CFDs, in commodities, into your shares, all that sort of stuff. Because people don't like locking in losses; they'd rather lock in a gain. Okay, so if Bitcoin's coming down, they think it's going to the moon, they won't close out that as it's going against them. They'll probably close out some share positions. Okay, so that's the problem that I can see occurring. But at the moment, Bitcoin's holding up. You look at Ethereum. Ethereum's down in that key level as well, that 1745 level. But to me, that's your leg down. That's a major, that's a no-no if you're a bull. You can see the highs are taken out, not by much at all, and then we've got this leg down. It's bounced, and then we've got a secondary leg down. It still hasn't resolved itself yet. It hasn't finished. We are down at that 1745, but there's a chance it could easily go lower. Okay, they need to break it higher. Bulls need to break it higher, but I think at the moment that's the biggest problem. People have been hurt quite a few times. Don't forget, everyone was talking up on Bitcoin, for instance. On Bitcoin, when it was up here, they're talking up 100,000. Every man and his dog was talking up 100,000, way it's going to go on, then it's been dumping on them. So anyone that's been bought up here, held through this, bought it up through here, bought into the highs, keep adding to positions, has either sitting on a big loss, depending on where their average is, or they're potentially going to sit on a big loss. That's what I'm talking about, margins, okay? And the potential for this to completely unwind, which could, like I said, could flow into other markets, but we'll have to wait and see how it's going. So that's a few things to keep an eye on. I think it's a few important things to keep an eye on there of the global market, the macro view. You've got the US dollar, you've got equity markets, which I think probably pop up a bit further, but it's that balancing act in the US especially. We've just shown our hand, the RBA showed their hand a bit by raising rates, but we'll have to see how all that plays out. Remember, CPI out on Friday, so better finish it there, guys. Thank you very much for joining me. Any questions, send us an email to tradethestructure@gmail.com. Take a look around the website, tradethestructure.com. Speak to you soon.